Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the S&P, the Qs, and most of the market ended green, but it wasn't such an easy session. It all started off very early this morning with a big dump. Take a look at this right here on the S&P. Huge decline here. And then the bulls were able to kind of bid this back up. Now, what exactly happened? Well, it was one of our volatility events for the week. This happened this morning, which was the ADP jobs report coming in for the month of November, minus 32,000 jobs on your private payrolls. The expectations were for 5,000 jobs in the positive territory. Unfortunately, we missed the mark, and we missed the mark in a pretty big fashion. Now, of course, this does wonders in terms of improving our rate cut odds for next December 10th meeting with the Federal Reserve and Jerome Powell. However, there is a lot of strain on the labor market right now, and this most recent report just goes to further that proof that the labor market is indeed the main concern, because we know that inflation is still somewhat muted, although there are some initial impacts from the tariffs. Of course, your true inflation index right now is sitting at 2.48%. This measures 15 million different products on a daily basis. I do believe it's a better representation of your overall basket of goods, of services for the consumer. So inflation isn't the problem, but more and more guys will start to hear about the weakness in the labor market. Jerome Powell started addressing this a few months ago when we started cutting interest rates back in the month of September, of course. And now the job worries continue. So it's a constant battle right now between the bulls and the bears. The bears obviously thinking that, well, maybe the jobs market might just be too far gone. But the bulls here trying their best to bid this one up throughout the day in the hopes of a rate cut next December, or next December 10th, next week, and also in the month of January as well. Will the interest rate cuts be fast enough to possibly stem the damage that is currently happening in the jobs market right now? That is going to be the key question in 2026, right? So pay very close attention to these jobs reports when they come out and how they come out. The headline news right here, the November payrolls unexpectedly fell by 32,000, led by steep small business job cuts, ADP reports. Larger businesses, entailing companies with 50 or more employees, actually reported a net gain of 90,000 workers. However, the establishments with fewer than 50, basically your small businesses, saw a decline of 120,000. So unfortunately, the declines in small businesses largely offsetting a lot of the gains from the big corporations here, or bigger corporations, which did have 90,000 workers plus. So tomorrow we get another one of these jobs reports. This time it's the Challenger job cuts reports, which I'll remind you just last month sent the markets into a bit of a tailspin. That day was pretty red across the board. You might remember it was like 1.5 down on the SPY, 2% down on the Qs. So this is another big volatility catalyst for the week. Thereafter on Friday, we do get the PCE report showing the inflation in the economy. So both PCE and core PCE will be reported on the Friday session. But as I said, I don't think the concern, and the market also doesn't think the concern right now is inflation, which is why you'll probably see the market move a lot more over the course of these job report days than they ever will in the future in terms of the inflation days overall. So in today's video, guys, we got a whole bunch of stuff to talk about because, as you can see, even though the indexes were able to bid us higher, we just haven't moved on the SPY at all in the last 4 days. Now, the bulls are still looking relatively healthy, and we might possibly still be due for an end-of-year rally. However, we do have a couple things to discuss in terms of the market momentum, the market breadth, etc., etc. So in part number 1 of today's video, we'll be going over 2 earnings reports. I know it's been a while, but we will be doing a couple earnings reports today. We'll be doing Salesforce, which came out with their earnings today, and CrowdStrike, which came out with their earnings yesterday. Shout out to all the other companies that have reported so far. But for today, we're just going to stick with those 2 very big corporations. Thereafter, we will get into the technical analysis portion of the video, going over the SPY, the QQQ, and your minor sectors as well. Check on the rotation, check on the market breadth, and the overall health of the market. After that, we will take a look at our big tech list right here and derive of these companies, right, which are possibly some good buying opportunities for either swing trades or additions to the long-term portfolio. And if we have time, because usually when I do earnings reports, that cuts into the time towards the end of the video, of course, I will try my best to cover the biggest gainers and losers of the day, but we've been covering these on a daily basis over the past week and a half. So you guys probably know where I stand on most of these companies and most of either the market narratives or the different sectors of the market. I'll try my best to include them at the end of the video. No promises. I'll have to check on the length of the video coming up. But if it's after, like, if we get to the end of the video and it's like an hour long, well, then I might not be able to cover them and we'll just have to review them tomorrow. That being said, let's not make the video too long, so let's jump right into the action, shall we? The SPY up 0.35, the Q's up 0.24, but look at this market breadth. Market breadth was actually pretty decent. If you take a look at the heat map right here, sure, we were missing a few tech components, Amazon, Apple, Microsoft, NVIDIA, and Meta, and Netflix, so most of your big tech components actually, but the whole rest of the market was kind of there to pick up the slack. Financials having a relatively decent day. Healthcare, not too bad of a day as well, even though you were missing the market leader, Eli Lilly, but that company carried the entire healthcare sector on its back over the course of the past month, so nice to see that sector continuing to broaden out a little bit. And the bottom half of the market not responding too well to, or rather responding quite well to the premise of interest rate cuts coming next week overall, as yields were down, and that does favor a few sectors of that of the bottom half of the market, such as industrials, real estate, and utilities. On your one-day relative performance, it looks something like this, to where most of everything was higher, but you'll notice technology was actually the second worst performing component of the day. Only one worse was actually utilities. Other than that, towards the top, energy, financials, industrials, and basic materials. And on your 1 week relative performance, you can see a more broad market than we were seeing roughly 2-3 weeks ago at this point, with most of your sectors in the green, but healthcare having a bit of decline, utilities and real estate down there as well. Overall, not a terrible day. Fear and greed index, well, we've made some improvements. We are no longer in extreme fear, which we were kind of trapped in for the past month of trading. Now we are only in fear territory, as several of your momentum indicators, although have gotten better. You can see here market momentum has moved from fear towards neutral as we create some space above these longer term moving averages. But stock price strength, right? Net new 52-week highs and lows on the New York Stock Exchange. It's been getting better, but you aren't really seeing many net new all-time highs. The pullbacks in November across the board were quite sharp for many names. And as a result, you're not really seeing many new all-time highs into the end of the year, at least not in a broad-based fashion. And stock price breadth has been improving, of course, from the lows, but still there is some room for improvement right there. If we take a look at the overall, the breadth indicators right here, you will see that percentage of stocks above their 20-day EMAs, that is still relatively healthy, guys, 70%. So here was the thrust that we were talking about, right? From very low market breadth all the way up to the top right now, which is a very good indication that, yes, the market is coming back, but we need to sustain this breadth, right? That's why those oscillators haven't come up and stayed higher since the October week, late October and early November period of time. So now that we're back up here, well, let's hope that the market can actually uphold this breadth, because that is what's really going to translate into further gains on the SPY and the QQQs. Percentage of stocks above their 50-day EMA. You can see there's definitely some room for improvement right here. We are nowhere close to the highs that we achieved in September and earlier during the summer, when the market was really booming and everything was clipping into new all-time highs. Well, almost everything, right? Certain sectors throughout this entire year have been soft, such as consumer discretionary, consumer staples, and other things like that. But we are making some improvements here. 54% of the S&P 500 is now above their 50-day moving average. This is a very important chart here for institutions. Usually when you're above the 50 EMA, institutions start bidding a little bit harder. And lastly, percentage of stocks above their 200-day EMA, net improvement here over the past few weeks, right? We are now back into some of the highs that we were seeing in terms of September. So all this means is that the short-term breadth has recovered, your medium-term breadth is still recovering, and your longer-term breadth, well, the dip in November was not deep enough to bring the whole market well below its long-term moving averages, but you did have a little bit of damage there. So the breadth overall is improving right now, which is exactly what you want to see coming into the end of year rally. But just pay attention, guys, to tomorrow. Tomorrow's going to be the biggest day, arguably, of the week, bigger than Friday, even though on Friday we get the PCE numbers and the Michigan consumer sentiment. I think a lot of the emphasis will be placed on the jobs reports moving forward. And as a result, tomorrow might just be another volatile day. If this one comes in bad, well, you might expect to see something as we saw this morning, right? A very rapid decline. But we will see if that happens tomorrow again. We will see if the bulls actually have it in them to bid it up, or whether or not we actually start saying, hey, maybe there's some sort of an underlying problem here, and maybe we actually do have to go into a bit more consolidation into support before getting some bullish news next week from Jerome Powell in terms of rate cut, which could maybe send us a little bit higher. So before we get into more market analysis, let us quickly go through the earnings that I have prepared for you guys. And number one is going to be this good old company right here. So Salesforce. Salesforce, by all measures, has been having a terrible year so far. The company is currently down year to date 29%. So there's a lot of pressure coming to this company. Now, of course, it doesn't help that when we started off the year, we were basically at the top end of a pretty big blow off top right there, but still they have not done anything this entire year. We weren't even able to recover after tariffs when the whole market was pushing. No, this one just kept dragging down to no fault of its own. In all fairness, Salesforce has been publishing some pretty good earnings, but it's the sentiment surrounding the stock about the fact that, well, is AI going to possibly replace some of this business's tools? But additionally, right, keep in mind that Salesforce is an enterprise resource software company, and they sell licenses by the chair, meaning that if you're a business with 10,000 employees, well, Salesforce is going to sell you licenses equivalent to the amount of employees that you have, especially if you're a white-collar business, such as a bank, an accounting firm, or other firms who use Salesforce's tools. That being said, if AI is supposed to replace a bunch of white-collar jobs, well, then the premise is that Salesforce is going to be possibly able to sell less licenses on a per-year basis, and as a result, over time, their organic revenue growth rates may go down. Now, I emphasize organic growth rates because for a long time, Salesforce has been growing through acquisitions. That's how they're able to keep their revenue up very strong. They acquired a few different businesses over the course of this year, such as Informatica for about $8 billion. And as a result, they're able to keep their revenue run rates a little bit high. But the organic revenue generation from Salesforce has been somewhat lackluster over the past 5-6 quarters. And every time we do these earnings, we kind of bring that up. That being said, that is the kind of premise or the thesis surrounding where Salesforce stands right now. Let's take a deep dive at the numbers real quick. So in terms of their EPS, nice beat on EPS here by about 14%. Now, the stock in the after hours initially went up like 5, 6, 7%, and then gave almost all of that move back. So we will see if tomorrow the bulls are able to get something going and start to challenge the top end of the resistance range here around 260, or if they just stay kind of down here in no man's land where nobody loves them. Moving on further, the EPS was very good, but the revenue, slight little miss on revenue by about 0.15%. And this has been the issue, guys. The issue has never been profitability or free cash flow for Salesforce. The issue is the revenue run rates. And we're going to talk about that as we move through these earnings slides. Some of the easy numbers for Salesforce right here. You can see that their guidance for Q4 sales estimate came in better than expected, 11.2 versus the 10.9 expected. EPS, arguably a little bit flat, 3.03 versus 3.04. And their end of year sales estimate, so this entire year wrapped up at the end of next quarter, where did they see their sales pipeline? Well, $41.5 billion in sales versus the estimate of 41.3. So fractional beats, right? We're not beating by huge margins, which is probably what Wall Street wants to see. They want to see the revenue turnaround story for this company. They want to see the growth acceleration from all the AI endeavors that Mark Benioff, the CEO, has been talking about Salesforce, that Salesforce have been doing for this entire year, such as their Agent Force program, right? And their end of year EPS, 11.76 versus 11.38. So it looks something like this, right? Revenue still a very soft 9% year over year. But I'll remind you, not all of that is organic. Some of that is through acquisitions. Now, there's nothing wrong with growing through acquisitions. Many businesses do that. But you actually want to see organic revenue growth too, that there's more and more demand for the product instead of the business just trying to protect its current status, right? RPOs, remaining performance obligations, that remains quite healthy, up 12% year over year to about $60 billion, which is healthy. Operating margins, this I got to give to them. They've done a really good job over the past year and a half of improving not only gross, but operating and also net margins. So that was very good. Operating income up 17% year over year. Companies able to cut costs a little bit to drive that money to the bottom line. And EPS was up 35% year over year. Now, take a look at Salesforce's revenue chart, and this is the revenue broken down into several components: the sales revenue, the services revenue, the platform and other revenue, marketing and commerce, integration and analytics, because they do all of that as well, and professional services, which is this tiny little gray white column at the bottom. You'll see what the problem is here, right? It's getting a little bit flat since 2024, isn't it, right? So, and outside of the pandemic here, from 2020 through, I would say about late 2023, the revenue growth curve across most segments of the business was very good. But if I put my mouse right about there, January 2024, the past 2 years, Salesforce hasn't really been growing the same anymore. The revenue run rates have been slowing down, and that's not only across one line of business, it's kind of everything, right? And that's been one of the reasons why people are having trouble getting behind Salesforce right now. is the slower revenue growth, but they haven't even really been materially affected by AI yet. So if they're already struggling to kind of rekindle the growth in the business across pretty much all segments here, what's going to happen when AI actually starts impacting, number one, the labor force for Salesforce's licenses down the pipeline, but also number two, if AI is just able to replicate a lot of what Salesforce does in an integral fashion, right? So there's kind of two overarching problems right now, or black clouds above Salesforce's business. Now, in terms of their Agentforce deals, it was pretty good. $1.4 billion in Agentforce and Data 360 ARR was generated by the business, annual recurring revenue, which is 114% year over year. So Mark Benioff's, attempts to push into AI with their new Agentforce component is playing off well, but so far remains to be seen how much business can they actually get, right? What's the total addressable market overall? And now that includes $540 million of pure Agentforce ARR, which is pretty good. In terms of the amount of deals, I'll show it to you guys up here. The amount of deals was actually not too bad. It was 18,500 plus new Agentforce deals closed since the launch, which is over 9,500 plus deals which are paid. So some of those are on trial and they'll be seeking to convert them into paying customers, of course. But that is good, right? But even in spite of all those deals, it's still not a huge revenue driver for the company, right? As you saw down here, even in spite of all those deals, where is it? It's only $540 million out of a $10.3 billion top line revenue number, right? So it's not the best, but it is growing. So it's definitely something to keep an eye on. Now, one thing that's working really well for the business is the free cash flow generation. Now they're actually back. Last quarter, when we covered this one, they were a bit soft on free cash flow because they were absorbing the cost of buying Informatica and a few other different smaller corporations over the course of this year. But now we got a pretty good free cash flow quarter, about $2.3 billion in operating cash flow, and somewhere buried down there is about $2.2 billion in actual free cash flow. So take a look at some of the highlights here, and this is pretty much where we're going to stop. Subscription and support revenue, it's up 10% year over year, which is okay, but Salesforce has been stuck at 10% for a while now. So not the best revenue growth coming into an AI narrative, right? Revenue was up 9% year over year on the top line. Remaining performance obligations, this is current RPOs, was up 11. That's not too bad. And take a look at some of the metrics here. We already broke these down in the previous screen, right? But I want to show you that here, they used to be growing, low teens, call it 13, 14, 15%. All of those lines of businesses have slowed down to either single or very low double digits, right? Agentforce sales, that's only up 8% year over year. Agentforce service, only up 8% year over year. Agentforce 360 platform, they're calling everything Agentforce now. The true Agentforce is not all of this, but now they're putting Agentforce in front of every single segment of the business there. So it is what it is, but here you go, right? Agentforce 360 platform, that was the highlight, 19% year over year, which includes the actual Agentforce deals, which we talked about previously. Marketing and commerce division, only 1% year over year. Soft. Integration and analytics, 6% year over year. So you see the problem here with Salesforce, right, is they have really good margins, right? Their operating margins are very decent. They've improved those over the course of the past year. The cash flows are very good. Free cash flow, $2.2 billion. And they do return a bunch of money to shareholders. Capital returns is about $3.8 billion in share repurchases and about $400 million in dividends. So they do a good job of putting this free cash flow to work in terms of buying back their shares, which contributes to positive earnings per share and makes investors happy at the same time. And they do still have a ton of buybacks remaining, guys. $22 billion out of a $50 billion total authorized, all remaining right now in the pipeline, which is about 9.5% of the float at current prices, at current market cap, which currently stands at about $227 billion, right? So I'm not going to take you guys through endless slides of Salesforce. I think you guys kind of get the idea of what we're saying here. The business has great margins. That's never been the question. The business has great operating cash flows and free cash flows. That's also never been the question. Matter of fact, the free cash flow yield right now is a very attractive 5.7%. But it is the sentiment surrounding the business. There's just more uncertainty around this business than there ever has been, right? There are other companies that are improving their offerings, such as ServiceNow, although they don't exactly do what Salesforce does. They have far better growth rates. And you can see what ServiceNow has done this entire year so far as well, right? Well, the answer is absolutely nothing. And the last time we covered this company, we were saying, this company has really strong growth rates still, but even they're not getting any love for the market. Software has been a very tough component of the market so far, and I would probably expect that to continue. I'm not saying that Salesforce will be stuck here down forever, but to truly see the momentum that this stock has seen previously, you're going to have to change that narrative. And apparently, quarter after quarter after quarter of solid prints. I mean, there's nothing wrong with these prints at all, right? It's just not enough, I guess, to kind of, surprise Wall Street in the best way and say, no, this business is definitely growing everything organically. Now, the valuation down here at 240 is indeed quite manageable as well. They're trading under a 24 price to earnings for 2026, 18.85, which objectively speaking is low. But keep in mind, they're not growing revenue that fast for the next few years, only 9% on average through 2027. Now, in terms of the PEG ratio, the price to earnings in relation to their EPS growth is the highlight of the business, arguably. They've been more profitable than ever, at least in the past few years, right? You're currently sitting at a 1.45 PEG, which is not bad. And like we said earlier, the free cash flow yield at 5.7 is also very strong. So if you're looking at this in terms of a pure play for valuation, you would think that this is a really good deal. And on paper, objectively speaking, in relation to past valuations, it is. It's down 29% year over year, but this play is not going to be for everybody, right? Do they have solid products? Yes. Will their products be replaced by AI? Potentially, right? Remains to be seen. Nobody is quite certain to what degree, that AI can replace a lot of these things. But if you just listen to Jensen Huang and many other experts on the topic, right? These businesses, these legacy software companies, guys, were built at a time where you needed true expertise. You needed to have a lot of capital to work on these types of products, and you need to have a lot of working capital too for labor requirements. You would need to hire very strong software developers and work with them tediously, right? Day and night, essentially, to build out the quality of product that Salesforce has today. With AI entering the landscape over the past 2 years, that's no longer the case. A lot of the code generation is now automated, and you guys see what Gemini 3 can do. So imagine in like a year or two, you might just be able to build, enterprise resource tools like this with just a couple prompts in the future. Now, obviously, it's going to be more complex than that, especially integrating it in a secure fashion across many different corporations. But that's the fact of the matter, right? It's an old school business model that was a very capital intensive business to start and scale. And now, unfortunately, the expertise that made this company so great is somewhat being replaced by AI. That's aspect number one of AI. Aspect number two of AI, well, it's just the unit count of licenses they'll be able to sell. If the white collar workforce gets trimmed because of improvements in productivity and efficiency by AI, well, this company's going to be able to sell less and less licenses. So it's kind of getting hit from all sides. If you just close your eyes to the narrative and purely buy it from the valuation, then, it can probably be a fairly decent bet. But this one would not be a core position for me. Would this one maybe be an attempt at the recovery of the software sector into 2026, as there are many other plays that are suffering the same fate? Just to name a few, I mean, Adobe, ServiceNow has suffered kind of a similar fate more recently, right? So are these companies bids? I mean, they are bids, but what I put this one as a core component of a long-term portfolio, being able to confidently say, yeah, Salesforce moat and Salesforce competitive advantages are never going to be challenged. I can't say that anymore, right? Previously, I would have been able to say that, but I no longer can say that anymore, which is why it's not a company that I would want to own for my long-term portfolio. Maybe I'm wrong, but that's just my opinion. I'm looking for clear companies with clear dominant moats that will not be replaced potentially by AI over the next 5-10 years. If I just constantly have to worry if this business is going to struggle with AI over the next 5 years, I'm not really interested. That being said, can I possibly position down here at the lows of valuation for a bit of a swing trade? The fact that it's down 30% year over, on the year so far, a swing trade possibly back into some highs, at which point it would still be a fair valuation for a bit of a swing trade. Yeah, but long-term position in a long-term portfolio for me, unfortunately, the answer is no. Sorry, I just disappeared on you guys, but I hit something on my keyboard. Anyways, that's everything I had for you guys for Salesforce. Hopefully you guys enjoyed that one. And now lastly, company number 2, which is going to be CrowdStrike, a company that does not struggle with AI. As a matter of fact, they're using AI to their advantage, a very fast-growing company. However, CrowdStrike is an expensive company right now and has been an expensive company. As a matter of fact, there was only 2 key times on the channel that I distinctly remember saying that CrowdStrike was an phenomenal buy. Number one was during their whole outage last year in 2024. You remember when Microsoft went down because of it, The airlines went down, then they got sued, etc. This was a phenomenal buying opportunity for CrowdStrike back there. And then the other one was during tariffs. But right now, almost back to the all-time highs. Is CrowdStrike currently a buy because of their very fast growth rates? Well, let's take a look right here at CrowdStrike, one of your market leaders in cybersecurity. EPS beat by about 2.23% and revenue beat by 1.65%. Not the strongest beats, but beats nevertheless. If you take a look here at the easy numbers for, that's not CrowdStrike. Where are my easy numbers for CrowdStrike? There they are. So CrowdStrike, very, very decent in terms of the guidance as well, right? Q4 sales 1.3 versus 1.29 expected. Your EBIT numbers 317 versus 308, and your EPS is supposed to come in next quarter at 1.10 versus 1.08. So you see, like, the company's beating, but it's not beating by super wide margins, right? In terms of your full fiscal year outlook, which is ending pretty much after next quarter, you're looking at sales of 4.8 billion versus the estimate of 4.79, EBIT 1.04 versus 1.03, and then their EPS 3.71 versus 3.68. So because next quarter's beats, right, or rather their guidance is not phenomenal, well, they're obviously not going to close their year in a phenomenal fashion in terms of surprising beats to the upside, right? Makes perfect sense. That being said, revenue numbers still strong, double digits, high double digits, over 20%, 22% revenue growth year over year. Net new annual recurring revenue, they added $265 million, which was a nice jump, 73% year over year. But look at sequentially, quarter over quarter as well, an extremely strong quarter for the business, their best ever at this rate. Operating income was also up 36% year over year, but this company has been struggling with just scaling into profitability, right? They spend a lot of money on research and development, and you need it when you're a cybersecurity company pushing the forefront of security for corporations, of course, right? They spend a lot of money on R&D. They also spend a lot of money on marketing to try and compete with other things like Palo Alto Networks and many other companies in this space, such as Datadog, Zscaler, so many different cybersecurity companies in the landscape right now. And I do believe this industry will eventually consolidate to where the bigger players are going to start acquiring some of the smaller players, because as of right now, right, the total addressable market is huge, but there's just so many different companies doing cybersecurity. And I'll show you what I mean when we go through CrowdStrike's, through their slides, right? Pretty much what I mean is, let me just scroll up right away, right? Or where can I find it? Right here, yeah? So CrowdStrike caters to 9 different various aspects of cybersecurity, but look at all within these niches of cybersecurity, yeah? Look at all the companies that do all of this stuff. This is what I mean when I say eventually I do believe that the industry is going to consolidate. But as of right now, CrowdStrike still spends a lot of money on R&D to stay at the top of the food chain, but also a lot of money on sales and marketing. So that is why CrowdStrike has struggled with profitability so far. It's not because it's not a high margin business. It's a phenomenal gross margin business. If you take a look at the gross margins right here, 75% gross margins, that's very solid, but they don't bring anything to operating margins because they spend so much money on operating expenses, R&D, sales and marketing, G&A, and then net margins as well have just been negative. This company's been struggling to achieve net margins, or positive net margins rather, right? That being said, very solid business and very solid growth rates. Let's move into some comments from management right here. So CrowdStrike on AI as the core long-term driver. AI represents our largest opportunity and demand driver yet. We are using AI to revolutionize cybersecurity, and even larger, we're securing the world's use of AI so businesses of all sizes can adopt more AI faster, securely, and with confidence. The transformative work we're doing with NVIDIA is representative of how we're securing AI at its very source, all the way down to its human and non-human users and its outcomes. I see this as a generational opportunity for the company. Jensen Huang summed up our market position best, saying, "I can't imagine a better defender than CrowdStrike," when he was talking on the stage at the NVIDIA GTC in Washington just a few weeks ago. So shout out to CrowdStrike. They're utilizing AI. The partnership with NVIDIA is obviously paying, dividends forward, of course, for the company. Now, that being said, we'll take a look at some of the highlights for this business, right? So we got to talk about the non-GAAP profits, of course, right? So subscription gross profits are very solid. As you can see here, non-GAAP gross margins, 81%. That's never been the problem, right? The problem is that they don't bring much of that to the bottom line. Now, non-GAAP will show you some pretty decent numbers, right? Operating income margins, 20%, 21%. So at least they're growing non-GAAP, but they still have yet to show a profitable quarter on GAAP accounting standards. Now, earnings per share, they've been having net improvements, 26% year over year. And free cash flow is also somewhat decent here at about $300 million. So it's nice to see them kind of improving that free cash flow, although they do use a lot of it to reinvest in the business. It's not as if they're buying back shares or anything like that. Yeah. So the key takeaways right here, as we said, ending ARR was up 23% year over year. Very strong. They're looking to be a $10 billion per on ARR by the end of 2030, which is good. So another 2x down the pipeline coming in terms of recurring revenue. Net new ARR, we talked about it, was up 73% year over year, which is very solid too. In terms of the new customers, right? Reflex customers as of Q3 over 200, which more than doubled quarter over quarter. Very high retention rate for this business overall, which is extremely solid. And we also have a few more highlights, which are very small right here, but they dedicate one big slide to it in terms of the modules. Yeah. So we went over the modules. These are all the modules: endpoint, cloud identity, threat intel, exposure management, AI security, all of that good stuff. Yeah. So obviously the goal for this company is to sell as many modules to a single customer as possible, saying, hey, what do you guys need? Do you guys only need cloud identity and AI, or can we sell you everything at the same time, right? So they've been trying to upsell customers. It's been working well. 49% of their customers have 6+ modules, 34% 7+ modules, and only 24% 8+ modules. But at least, if they're talking about 9 modules, well, at least 50% of the customers have 2/3 of all of what CrowdStrike offers, which was very good. And that is a big takeaway for this business overall. Some other small little highlights, guys, but that's pretty much the gist of things, right? Here's your quarterly ARR and revenue growth on a chart. Very solid, right? Not like Salesforce. This one's just streamlined to the upside, still 20+% revenue growth, at least for the next few years as well. And the line driving down and now up a little bit right here is the annual recurring revenue change, right? So obviously it was a lot higher when the business was smaller, and then the law of large numbers kind of catches up to you, right? But they're still sitting pretty into the low 20% range, and that should still be the case here, guys, in terms of ARR year-over-year growth in terms of the next few years for the business overall. So very solid growth by this fantastic company with amazing products. Now, that being said, in terms of the forward growth, just to give you guys a glimpse of the estimates right here, yeah, EPS, solid increase in through 2028, and then also in revenue as well, right? Very solid revenue push. As the company did state many times over the last few quarters, they want $10 billion in ARR by 2030. I do think that is largely achievable by the corporation, but as you can see from last year, 2024 through 2028, they're going to double their revenue, right? So revenue is still one of the biggest components to focus on for this business. So that being said, right, what about the valuation? Right now at 524, well, I did this valuation earlier today when the stock was kind of down here after their earnings at 505. It's roughly the same thing, right? Plus or minus a few percent. Now at 505, is the company a good deal? The word deal is questionable, right? It's 105 in terms of forward priced earnings. That's not terrible, if you at least have a very high revenue EPS growth rate, which they do. EPS growth rate is 25% right here, very solid. It gives them a 4.24 PEG though, which is very high, guys. Objectively speaking, it's very high, right? This is like Palantir numbers. It literally is Palantir numbers at this point, right? Palantir at 150 is 4.73. So CrowdStrike, kind of like Palantir, but they're not growing revenue as fast as Palantir, but still doesn't matter. And a forward price of sales of 21.64. Now, the problem, guys, is that no matter what you use to analyze this company, it is very expensive. Even if they say that $10 billion is going to be the revenue run rate by 2030, they're trading at 20 times price to sales, right? 20 times 10, that's $200 billion in terms of possible market cap if they still keep, and this is very high, guys, not many people trade in excess of 20 forward price to sales year after year after year after year, especially into 2030, right? Maybe at that point, the revenue growth rates will be kind of slowing down, kind of like we saw with Salesforce and many other businesses. So to expect this company to still trade at a 20 times forward price of sales in 2030 is slightly high, right? That being said, you have your target, right? You have $10 billion as the company's own guidance by 2030. Their market cap right now is $131 billion, which means that if they're tentatively going to be worth $200 billion, which is literally 20 times ARR, right, into 2030, well, I mean, it's very simple, right? If you want to know how much lift you have on this company, right, you got about 53%. before you have to expand the multiple, because it won't come from fundamental expansion. No, that's the company's guidance, right? So 53% compound annual, well, that's not compound annual, but 53% gains possibly for the next, what, 4 years, maybe 4.5 years type of thing through the end of 2030. It's not the best compound annual growth rate, right? If you just divide this out by 4 years type of thing, it's like 13% per year. And that's per the company's own guidance. If the major assumption that they keep up that the market allows them to keep a 20 price to sales multiple, that's kind of tough, right? Which is why I say on this company, this is a phenomenal business, but sometimes you have to differentiate a business from its stock. And this stock is objectively expensive. There's not enough meat on the bone for me to say this is a screaming opportunity. The last time we said it was a screaming opportunity was last year and earlier this year during tariffs. Then you could justify that because they still had the 10 billion in ARR. Well, the people that are up from the tariff lows, right? I mean, they're up huge. They're like 70, 80% from that point. Then it made sense. But does it make sense from here? No. So CrowdStrike for me is a hold. Fantastic business. Nothing bad to say. One of the best players in the entire cybersecurity landscape right now. That being said, guys, unless there are some material changes to management's forward guidance for 2030, the valuation right now arguably doesn't make that much sense in relation to other opportunities in the market. So CrowdStrike for me is not a buy. It's not a sell. If I'm in with a very good cost basis, I'm making my compound annual growth rates, no problem. But starting a big position from here, debatable, right? For me, it's just a hold at this current time. So hopefully you guys enjoyed those two earnings breakdowns on two very different companies, two software companies though. And that's it for our earnings presentations. Hopefully you guys enjoyed. Now, let's dive into some charts, shall we? We're going to start off with the good old S&P 500. So the good old S&P is going to be beholden to that Challenger jobs report tomorrow morning, as I said. That being said, the bulls are still in full control of this move right here. Very nice bounce off the lows. I'll remind you, daily downtrend has now been engulfed. We got a lot of space off the lows at this point, anything above 651. Just looking for a new higher low for possible further trend continuation. If tomorrow's jobs report sends us lower, you guys know the drill. The EMAs are down here. We do have nice support, right? 674 down about 666 could be a nice fallback location. Possibly, if we erode these market gains into the end of the week, well, next week you got something very big to look forward to, which is going to be the rate cuts, but also Jerome Powell's comments on the labor market, the inflation, and that good old duality that they always talk about, right? Moving on to the QQQs right now. Same concept. Qs are doing really well. Very nice size bounce off the lows right here. Daily downtrend has now been engulfed. Very nice, creating a ton of space. Your higher lows are here. 581, and we are above the most recent area of support, which is 613, down about 605. So working with a decent amount of space, but if the job report is bad and sends us a bit lower, guys, do not be surprised. It would just be a normal market pullback. We have a lot of space to create the daily uptrend possibly into next week if that is the case. If the Challenger jobs report is not bad and the markets absorb it well, we can continue, but eventually the bulls will have to kind of sit down and create your daily higher lows. They do it all the time, right? The market moves in waves, never in straight lines, yeah? You're always looking for the catalyst for the next possible wave down. And tomorrow, and arguably Friday with the PCE, you have two of them. So just pay attention, guys. And if you have been paying attention, have been taking profits on some of your short puts that you've been doing so far, right? Selling put options and whatnot. I have some decent buying power leading into possible downside in the market. So I'm looking forward to picking up some of my favorite companies in the event that we get a few days of weakness moving forward, but not trying to predict. I'm just saying that's how kind of I'm positioned. And if the market just rips, no problem at all. I have a ton of longs and a ton of leap call options as well. So I'm fine either way. Moving on to XLF Financials. Great move by Financials, man. Setting the higher lows yesterday and going for it. Smashing through resistance. 53.30 down about 52.90. Now, obviously, a major reason for the move in Financials today was because your yields kind of came down, right? The 10 and 20-year yields came down a little bit here, the 10 and 20, and obviously your rate cut odds are now close to 90%. So Financials really enjoying the fact that we're probably getting a rate cut into next week, which is going to be very solid. And as a result, you got a nice daily uptrend going right here. Your higher lows are still set right now at about 52.64, which is the confluence of the moving averages as well. You would like to see the bulls create a bit more space here and trying to attack these all-time highs at around 54, but Financials not looking too bad. On the longer term time frames though, guys, it's still very, very, very choppy, right? Weekly downtrend, you got a nice engulfing move. They're gonna have to change this around eventually. And the monthly has also just been a large consolidation range right here. As you can see, we were always trying to set the monthly higher lows, which possibly were achieved during the sell-off in November. And now looking to maybe march on a little bit forward. The banks will benefit from those rate cuts. Some of your credit card companies will benefit from those rate cuts, and possibly many other financial names, especially names like SPGI and Moody's, which have huge debt refinance pipelines in the future. Not these companies specifically, but that's their business, right? They rate debt. That's the credit rating agency component of those businesses. So as rates come down in 2026, a lot of companies will be reaching out to S&P Global and Moody's to have their debt re-rated so that they can possibly issue financing at lower interest rates than they currently have right now. So keep that in mind. Those are a few very bullish plays into 2026, in my opinion. On to healthcare. Healthcare also, not too bad of a day for healthcare, but still in the confines of consolidation right now. That being said, higher lows are down here, 151, still very healthy into the daily 12 EMA, which, I mean, we've challenged a few times, but, we haven't really lost substantially since the end of October right there. So still a very nice daily uptrend, but I'll remind you, right, we did achieve new all-time highs. Well, actually, sorry, I'll take the dividends off. Very close to new all-time highs without those dividends. That being said, we're stretched on the price, stretched on the weekly timeframes right there on the RSI. We are very stretched on the daily RSI. So if it translates into a daily downtrend and a bit of a cool off for the healthcare sector, it'll be very normal and natural, in my opinion. Beautiful weekly uptrend, tons of space to come down and maybe sit on this area right here, which is around 150. It's like these guys in the 12 EMA. You wouldn't be surprised to see a bit of healthcare consolidation. It's been a phenomenal move. And even on the monthly, right? A bit of consolidation after such a strong November close could be what the doctor ordered. No pun intended, because it's healthcare. You know what I mean? Anyways, sorry. Moving on for possibly the continuation of the monthly uptrend here into 2026. So looking good. I'll be looking maybe for a few healthcare names here and there if you do have a bit of a pullback here throughout the month of December, as they did a lot of the heavy lifting in the month of November. Moving on to semiconductors right now. Semiconductors, another very strong day for semis, and they're doing it all without the help of the market leader, right? A lot of the gains were kind of in the bottom half of semiconductors. You can see some names here like, Qualcomm, Texas Instruments, NXPI, MCHP, ON, and those are all your analog devices, right? Look at some of these companies, man. They did nothing for the past few months. Look at ON. Look at MCHP, right? Very solid moves. Texas Instruments has been doing nothing for a while. Big pop off the lows right here. And even Qualcomm, they haven't been doing much of anything, right? But nice upswing here. So whereby you do not see the market leaders anymore, such as NVIDIA and even AMD, which has just kind of been muted over the past, let's call it 2, 3, 4 weeks at this point, right? Well, at least the rest of semiconductors are kind of there to pick up the slack. That is what you want to see. That is intra-sector rotation. So within the sector, you're seeing some rotation. Very good. Moving on, daily downtrend. Nice push here. Huge engulfing move by the bulls. And we got a lot of space here to kind of create some higher lows. Anything above 315, looking for some higher lows for possible further trend continuation. If we do get a pullback into the next few days, I will be ready. But for now, I've just been playing some of my favorite names, right, that have been low, namely AMD and NVIDIA. Especially selling puts on those companies has been a profitable endeavor so far. Looking forward to keeping that going. On the weekly overall so far, weekly higher lows are now set, and the bulls just looking for a bit of expansion. So not looking too bad, man. The bulls are kind of back in the driver's seat for semiconductors right now. Good to see, but eventually you will want to see those market leaders kind of start pushing a little bit ahead, especially NVIDIA, right? Moving on to the Russell right now. The Russell, 1.82% to the upside. Of course, it's because of the rate cut odds now a lot higher, right? So the Russell's been moving really well, responds very well to any fluctuations in your forecasted yield. So that being said, new daily uptrend, higher lows are set at the lows of yesterday, 245, and now we are looking back to the all-time highs, 252, not looking too bad at all. On the weekly is a very juicy bounce right now as well. You saw that they did lose the weekly uptrend back here, and now almost a fully engulfing move. So if you somehow see any weakness here over the next few days, guys, on the weeklies, you got a lot of space here to set up some new higher lows and get this weekly uptrend back and kickstart the continuation of maybe this monthly uptrend into 2026. Small caps, of course, respond the most to changes in the interest rate, and that is why a lot of these have been running pretty hard. And that's pretty much everything for your overall market rundown. But shout out to a lot of these other niches of the market, namely consumer retail. Consumer retail has been on a tear, very big tear, right? And not only since the Black Friday numbers, no, started kind of early last week, right? Huge push in XRT right here is a weekly downtrend. Now the bulls making quick work of that weakness that started in the month of September overall. So will we be able to see a weekly uptrend recapture and maybe monthly expansion of consumer-facing stocks? I know, Crazy thing to say, right? Especially after they've done nothing for the better part of the last 2 years, but you might not be looking too bad into 2026. But of course, this is for a no recession scenario, right? If you somehow get an unemployment recession or an economic slowdown, which is tough to do with AI, right? Most of the weakness is going to come from jobs. If the consumer stays resilient, if the jobs market doesn't fall off a cliff, then maybe 2026 could be a much better year for consumer retail than 2024 and 2025 have been. At least that is how your monthly chart is set up. But any further weakness on jobs or any further weakness in terms of the quote unquote K-shaped economy, and you're just going to further consolidate, right? So it's a bet right now. Consumer retail and even consumer staples, it is a bet. It does not come without risk, but it is somewhat of a decent bet that you can possibly make for the market. What I'm trying to say is the risk to reward right now is skewed in a favorable nature, but it does not mean that there is no risk, right? So we'll do more sector rundowns coming into the Friday video. The VIX is still low. The yields are kind of oscillating, which we've talked about previously. So I'm not going to cover those every single video, only when it's noteworthy to us. Moving on to gold right now. Gold, not too bad of a day, but still just in a bit of a consolidation phase on gold right now, yeah? It's still a nice daily uptrend. We're hunting for some daily higher lows, but you know, the velocity in gold is not what it was back here, right? So the bulls are in control, you know what I mean? But it's just not the same anymore, is it? So we're hunting for a higher low, anything above 4,050, just looking for a new higher low, possibly for further trend continuation, not looking too bad. On the weekly, we're looking okay, but if you just get stalled out here and consolidate, you would also be looking at something like this situation where we ran really hard and now we just have to kind of consolidate it to maybe a tightening range like this and maybe even cool off the monthly time frame as a result. As of now, there's no indication that that's the direction that we're heading. But if you take back too much of this move, well, that's probably going to be a likely scenario. You might just come into some form of a consolidation range to kind of end the year, and then we will revisit the gold trade into 2026. But as of right now, short-term bulls are in control. Just something to keep your eye on in the event that you give back a lot of that weekly move, right? Moving on to Bitcoin and Ethereum. Bitcoin and Ethereum doing pretty good today. New daily uptrend confirmed. We talked about this yesterday about the ability for the bulls to complete this daily uptrend. That's notable to us. We have not had a daily uptrend on Bitcoin since all the way back here, end of October. So it's been a while, right? Now we have a daily confirmed uptrend. So looking good. So your weekly lows are now set. And now the question is, how long can they maintain this daily uptrend? Well, if you're looking for the full reversal to the upside, right? So you have to capture, number one, the daily time frame, which is done. Then you have to recapture the weekly uptrend because this is a weekly downtrend still, right? And that all starts with a good size bounce on the weekly, which is just daily uptrend continuation, right? That being said, you got to give me a bounce at least up to 100K. Get me into the 100K, 103K area of resistance, this area up here, yeah, which is a nice fib retracement. It creates some nice space off the lows to eventually reset this weekly uptrend. But you guys know the drill, right? How long does it take to reverse the daily uptrend or the daily downtrend into a daily uptrend? Well, it takes days and days and days. How long does it take to reverse a weekly uptrend? Well, it takes weeks and weeks and weeks. So are we looking for a V-shape back to pure all-time highs before the end of the year? Probably not, but this is a very nice start. So we'll keep our eyes peeled. Bitcoin is still a decent longer-term bet. In terms of some short-term swing trades, we talked about it, right? Your entry is on the daily uptrend break right here. Stop goes below the low, and then you're targeting these guys up here into the mid $100,000 range. Not a bad risk to reward short-term trade now that you have established a bit of short-term time frame control. Same thing for Ethereum. Ethereum, very nice push on the network right here up on the Wednesday session. 6%, very strong move. Daily uptrend is now confirmed. Bouncing out of support right now, which is about 3,250 down about 2,800. That being said, you guys know the daily bulls are back in control, but this weekly downtrend is very substantial, right? So that being said, give me a nice weekly bounce. I would like to see a bounce at least to about 3,500, a 50% retracement, or even a little bit higher if they want to come into the 3,600 level. I wouldn't be opposed to that, but you will need to eventually reset the weekly uptrend to say, okay, yeah, this is indeed the monthly bottom, and maybe we're going to go into some form of an extended rally here into the early stages of 2026. Obviously, the rate cut cycle is going to help this, but you need to see more risk on momentum. So far, we haven't really seen much risk on momentum on a lot of the risk on names. Not only crypto, but, you know, some names are coming back slowly but surely, like Palantir or like the Robinhoods, right? Like the Rocket Labs. Rocket Lab is kind of starting to go up here. Some of the quantum names today were up small, you know what I mean? The neo cloud providers are trying their best, right? These are all the risk on trades, you know what I mean? To where you get a lot of momentum. It's very risk on. People don't really care about the valuations anymore. You guys know what I mean when I talk about the risk on trade. I'm not saying that some of these companies are risky. I'm just saying they represent the risk on trade. So until you see big pushes into that risk on trade with clear narratives, well, you're probably not going to see crypto fly leaps and bounds as it was kind of in this period of time, July through August type of thing, right? So just some food for thought. Obviously, I'm not trying to predict. I'm just trying to say where we're at and maybe what to expect in terms of, logical velocity for this market until you recapture the risk on trade, which has to do a lot with, the breadth, the net new highs on the stock exchange, and just getting out of this overall fear environment, which is very clear, right? Now, that's it for your overall market rundown. Hopefully you guys enjoyed it. Let's run through these big tech names. And sadly, at the length of the video right now, probably not going to have time for the biggest gainers and losers, but just go back and check my video from yesterday. I pretty much cover almost everything, all the possible topics, all the possible narratives. And we've been doing a pretty good job of tackling these after every single video of the past few weeks. It's just that when I do earnings, guys, it takes up quite a time slot in the video. So we'll probably do these tomorrow, those biggest gainers and losers. But now let's dive into our big tech names. And starting off with good old Apple, I got an Apple headline for you right here. Apple on track to ship 245 million iPhones in 2025. This is indeed their best showing since 2021. It's been a long time, driven by the iPhone 17 sales and the China rebound, of course, which is 6.1% more sales than they had in 2024. Very solid, very, very solid. And Apple has great guidance for Q4, but even in spite of that news, the stock currently is down on the day. It was daily overbought conditions. Apple's had a tremendous rally the past week and a half of trade. If we get a pullback, maybe coming down into here, 275 in the daily EMA, looking for a bit of a daily higher low, maybe to continue the daily uptrend, but we are quite stretched on the price right here. The weekly is also stretched too, weekly overbought conditions, and you can see we are stretched from the weekly 12 EMA, but not only that, from the monthly 12 EMA as well, right? So I'll be patiently waiting on any pullbacks on Apple. If we do fulfill the good old monthly higher low prophecy and come down maybe, 260, 250-ish, I'll revisit this one for some trades. But as of right now, not my favorite candidate for some swing trade longs, even though they will be having a decent Q4. The price is just a little bit too stretched for me. So Apple is not a buy for me either in my long-term portfolio. The valuation is quite extended here at the mid-30s in terms of forward valuation, price to earnings, and a 3.2 peg. So a little bit too rich for me, both for some swing trade longs, a bit too greedy for me of a trade, and also for a buy. Apple for me right now is just a hold for some long-term shares. No swing trade positions for me. Moving into AMD next, AMD up 1.10%, but AMD, had a really good push last week, but the last 4 days it's just stuck here doing a whole lot of nothing, yeah? That being said, it was a nice daily downtrend here by the bears. We got a nice little daily uptrend shift by the bulls, and they're looking for a bit of a higher low, try and keep this balance going because, although the weekly is in control by the bulls, right? They had a really big pullback here. It's pretty sizable, right? From the top to the bottom, that was 27%, and what it seems in like the blink of an eye, right? In the event that you keep being a little bit weak here, a little bit soft, and move towards these lows, I'm a big fan of selling put options down here, 190 down to about 175. We've been making a decent amount of money in the Discord, targeting this whole area. So hopefully you guys were able to kind of find some similar trades. AMD for me at this current stage right now is indeed a buy, especially for a long-term portfolio. If you believe in the long-term thesis, around the $200 range, I mean, it's 220, so just add 10% to this. It's like a 1 peg, like an 8 price to sales, which is not too bad in terms of the revenue and EPS growth. Should be pretty solid. I'll remind you of the long-term thesis of AMD, right? They still haven't had nearly close to their best showing in terms of fundamentals, right? 2026 is the start of the big growth expansion on EPS, profitability, but also in terms of revenue. That's when they really start scaling the revenue aggressively in terms of their data center offering. So it's a nice starter position here for AMD, but I'll remind you, if we're starting a position here, we can't be wanting super, super quick gains. You will probably never make as quick money as the people like us who bought back here. That quick money is finished. However, can we have sustained runs throughout, 2026, 2027 as the company keeps improving its fundamentals? Yes, there's a lot of meat left on this trade, in my humble opinion, but you got to pace yourselves essentially, right? Now, the expectation for these crazy 30% pushes in like a week worth of time with the OpenAI deals are probably behind us, but we can see some sustained growth over time. And I do believe that this monthly time frame will just continue expanding, especially into 2026 with the expansion of the company's fundamentals. Moving on to good old Amazon right now. Amazon still stuck down here, 0.87%, getting rejected at resistance right now. 240 down about 230 is the resistance pocket. I mean, the bulls have struggled with this a number of times previously, right? And today is kind of no different. Daily downtrend, nice size bounce. Put the bounce on the fibs, as we've been saying. It's a nice size bounce. It was a 61.8% bounce, which does give the bulls a very good chance of, if we try to hit a higher low, trying to convert this into a nice daily uptrend. If you do move a bit lower, I'll be doing a few things, picking up some shares, but also selling some put options down here in the lower 220 range. It's been also a very profitable endeavor. Every time we've done that over the past few months, we have been decently rewarded. Down there is also huge support, monthly support as well, talking like 220 down to roughly like 205. And you got the 12 EMA there as well. We're just looking to kind of continue this monthly expansion phase on the stock overall. At 220, the valuation is very manageable for Amazon as well, which is why I'm a big fan of selling some put options down here for any trades, but also for some shares to add to the long-term portfolio. Moving on to Google right now. Google, strong push today, 1.5% to the upside. We will see how long Google can actually keep this run going. Looking pretty good though. Huge move by the bulls. They're looking for daily uptrend continuation. But if you pull back a little bit more, right, essentially what you're going to be looking for here is the weekly higher lows, because now we're very stretched on price. Let's be honest here, guys, right? It's been daily overbought conditions for a while. It's been weekly overbought conditions for weeks and weeks and weeks at this point. It usually does not last forever. And monthly is also overbought conditions too. So swing trade longs on Google from here, very greedy trade in my opinion, but possibly playing this one on a pullback. If you get a nice pullback here, for whichever reason, into the 300 down to about the 280 range, this little pocket, 12 EMA, right? And it will be a nice cool down on the monthly timeframes as well. Maybe we can explore some swing trades, but Google is gone at this current stage. Overall, though, in terms of long-term portfolio pickups as well, it's not super rich, but it's not cheap anymore, right? It's trading just under a 30 forward price to earnings, a 1.9 peg. So gone are the times where back here Google was trading at almost a 1 peg and like a 16 forward multiple. Now it's 2x'd almost very rapidly in price. So unfortunately, Google is not my favorite buy in the market right now. Am I selling any shares? Not for my long-term portfolio, but if I had swing trade shares that maybe we bought back here or some call options or things like that, then I would probably be repositioning some of these swing trade longs or some of these swing trade leaps into other names that just haven't had the size of this rally so far, but I'm not selling any of my long-term shares. And for long-term shares, I'm probably not buying any more up here either. So Google for me at this stage is a hold. Moving on to Meta. Meta down about 1.16% today, and most of that just came awkwardly into the end of the day, right? They start off the day chopping around here, and then something happened towards the end of the day. No news, really. Just a very awkward sell-off at the end of the day, right? That being said, daily downtrend, nice engulfing move by the bulls from this most recent leg of selling. And now, if we do move a little bit lower, you guys know what we're going to be trying to go for, right? The infamous daily higher lows to change the trend back in the bulls' favor. If we do pull back here, there's a few different things that we can do. If you have a very large portfolio, selling some put options down here, not the worst proposition, and even picking up some shares for the long-term guys around 630 or lower. The valuation on Meta is very manageable at a low 20s forward multiple, a 1.63 peg overall. Very decent valuations. We're just hunting perpetually here for the monthly higher lows as well. And so I do want to target this area down here as close as possible to 600 for any long-term share pickups, but also maybe for some short puts as well. I like Meta down here. Sure, there is a narrative right now that they're spending too much money on CapEx and that their expense profile has kind of crept up on us, but it still is a very highly profitable company with very strong free cash flows and, you know, large competitive advantages in the advertising space. So if I'm buying this business, I'm not buying it for the short-term expense narrative. I'm really buying it for the long-term moat that the company has built over the last decade or so, right? Moving on to Microsoft right now. Microsoft down 2.5%. Now, there was a report that came out very early this morning of, this was kind of like a hit piece of lowered internal sales targets for AI products, reflecting weaker demand from corporate clients and missed sales goals. Now, this was a third-party report, but you know what's funny about that? It's about 2 hours after that report came out early this morning, Microsoft came out and publicly said, no, we never said that. That's not true. So there was a lot of push and pull on Microsoft stock, especially to start off the day right there. You can see the damage was done with that report. And then they kind of closed very soft here into the last hour of trade additionally too. That being said, Microsoft, in terms of the price action structure right here, rejection from resistance. And we were talking about this, right? To where yesterday we were into resistance. Now you got the news event, which kind of sent us lower, but the price action was kind of showing that this would have been a very tough ask for the bulls maybe to get through in one clean shot. Resistance stays put, 500 down to about 490. And now there's a few different things that we can do on Microsoft as well. It is a downtrend. The bulls have a chance to reverse this. Not the best chance because the size of the bounce was only like a 50 to 618 bounce. So it's a good chance, but a bounce is only a bounce until you can actually change the trend. Unfortunately, we're back below the 200-day EMA. If we revisit these lows or maybe even lower, Microsoft is a phenomenal buying opportunity for the long term, in my opinion. Weekly is still in a bit of a consolidation phase, and the monthly also in a bit of a consolidation phase at the same time. That being said, the 12 EMA is right here. So I want to play this pocket. Call it 470 down about 450. This is where I will be buying Microsoft shares for my long-term portfolio. I've been waiting for it for a while, but also with the big accounts, selling some put options, 460 down into 450, not too bad at all. The big long-term moving averages are there. Historically, it's been great picking up Microsoft anytime they come to the 12 or between the 12 and 26 EMAs. So I will play those statistical odds, but additionally, the valuation now at 470 is very manageable, right? It's a under 30 forward price to earnings multiple, a 1.66 peg. So it is not, rich anymore as it was up here at about 560, 550. We are getting a nice discount for this high quality, long-standing business. Now, moving next on to Netflix. So Netflix got put through the washing machine today as well. At one point today, Netflix was down over 6%. And the reason being is, well, they're bidding officially for Warner Brothers Discovery. This is a $60 billion company, and all of the bids from different corporations have come in around this current share price. So if they do get bought out, it's $60 billion. Now, Netflix does not have $60 billion in cash, so there probably would be a decent amount that would be raised in terms of debt. And as of recently, Netflix has been a somewhat capital light business. As you can see on the balance sheet right here, they don't have too much debt, $17 billion in debt, but $9 billion in cash on the balance sheet, and they do bring in under $3 billion of free cash flow per year. So their balance sheet now is healthy. But of course, if they win the bid, well, they'll be getting a lot of very nice IP and a lot of very nice assets with Warner Brothers Discovery, such as HBO and things like that, right? But it is going to somewhat, hinder the very strong balance sheet that Netflix has been able to pride itself on over the last few years. Now, only the news that they were bidding, right? Officially bidding, because there was rumors that they were going to bid. Now they're actually bidding. That was enough to send the stock down 6%. The deal is not even concluded. And immediately when Netflix started bidding, well, then you had some concerns by, different agencies in terms of, antitrust cases, in terms of, well, would this make Netflix too dominant of a company? So the company got hit by both of those news pieces over the course of the day. That being said, when sometimes some things drop, it can be very good opportunities. And I do believe that today is another example of this, right? Daily downtrend right now. Size of the bounce of the most recent move was not the best. We talked about this recently, right? It was a 50% bounce, which is okay. But then again, right? One big piece of news and you are coming down further on this daily downtrend. The weekly has been a downtrend for a while right now. Netflix is just proceeding to give back its year-to-date gains. You might remember at one point in time, this company was up like 45% year-to-date. Sadly, it's given back a lot of that so far, 23% off the highs. Year-to-date performance now only up 16%, unfortunately. So that being said, daily downtrend continues, weekly downtrend continues, not oversold on the weekly, not even oversold yet on the daily timeframes either. So if you do keep pushing lower, even on this monthly, guys, you're coming into the pocket that I've been waiting for a while, right? You remember me talking about this one, 110 down to just under $100. This is the pocket in which I want to accumulate some shares. I've been waiting for it for a while. Now it's here. So now I do definitely want to be bidding. That being said, support below is about 100 down to about 90, this little pocket of area right down there, down into the 26 EMA, usually picking up Netflix between the 12 and 26 month EMAs has been a good buying opportunity every single time it happened. Of course, there was the big sell-off in 2022, but that was a bear market, right? In the context of bull markets, though, it has usually been a good proposition. And there's nothing wrong with this business at all. Right now, they're trading at a low 30s multiple, a 1.62 peg, so a manageable valuation. So as a result, I do want to pick up a few more shares as we move into this location. On to NVIDIA right now. NVIDIA just unable to shake it. I mean, Jensen Huang went on Joe Rogan today as well, right? Kind of making the case not only for NVIDIA, but for AI as a whole over the next 5 to 10 years. It was a very interesting podcast. Definitely recommend that you guys check it out. But recently, NVIDIA has just been kind of trapped down here, right? In the whole, 170 to 180 pocket, which is good for us, especially for selling puts down here on the company, or if we're looking to accumulate more shares, they're giving us more time to do so. I don't think the fundamental thesis of NVIDIA is broken at all. It's just been very soft in terms of price action. Daily downtrend, I mean, the bulls are trying to go for the expansion, but it seems as though every day, right, they try and they just are not able to get it done. That being said, we do not have the weekly uptrend momentum anymore. We lost the 12 EMA, we lost the uptrend, so now it's just consolidation mode, just very awkward sideways consolidation, monthly consolidation at the same time, and I want to play this pocket, man. 170 down to about 160. This little pocket support, which we just established previously here, right? Big support into the 200-day EMA, which is the monthly 12 EMA. So I want to play this pullback for the higher lows on NVIDIA, selling some put options down here, but also accumulating some shares of this fantastic company, which right now is trading at a very low multiple, 26 forward price to earnings and a 1.15 peg. Very solid numbers for NVIDIA, and there's definitely no fundamental problem here, in my opinion. Moving on to Tesla right now. Tesla, very strong day here, 4% to the upside, looking very good. A lot of the focus on Tesla recently has been on FSD, but also on robotics, but especially on the energy business, which would come in clutch, especially at a time over the next 5 years where the United States is going to need a lot of energy, right? And Tesla's energy in terms of battery storage applications can be repurposed, I assume, to commercial purposes. Now, so far residential, but also possibly commercial purposes as well. They're very good in battery storage technology, let's be honest, right? Daily uptrend is very strong today. Super good momentum right now on the stock. And the support level below is 430 down about 415, looking pretty good there for the bullish daily expansion. Any weakness will have you see a weekly or daily higher low, anything above 382, looking for that daily higher low, maybe for more momentum continuation. Moving on to the weekly timeframes here, it was a weekly downtrend into support, and we were talking about this weekly downtrend. What were they going for? They're going for the monthly higher lows. Yeah, nice monthly uptrend right now, monthly higher lows, and now the bulls might just be looking to get it back. If they can V-shape this, beautiful. If not, if they have to do it in 2 clean shots, you guys already know the drill, looking for the weekly higher lows, and this might just be a last re-entry opportunity for anybody who's swing trading Tesla overall with a tentative stop loss. If you're going for the big move, right, on the weekly higher lows, stop loss will go down below there, and then you're targeting big expansion into 500, right? So not day trades, but like longer term swing and position trades overall, but looking good on Tesla. Moving on to Palantir right now. Palantir up 3%, starting to challenge the resistance range, 185. Down about 170 is your big resistance range. It was problematic for, both the bulls and the bears at certain points right there. It's a big area of price action control, yeah? That being said, the daily downtrend engulfing move by the bulls, looking pretty good right there. So any move lower, they're going to be looking for a higher low. Anything above 150, looking for that higher low for possible further uptrend continuation. If you just falter back here a little bit, no problem at all. That's the bulls just telling you, okay, getting rejected at resistance, and maybe you have to try for a bit more momentum, curling over down there. If we get a bit of a soft move on Palantir down here, maybe you will find me selling some put options down here, 150, then about 140, which is your support pocket, but also your 12 monthly EMA for a casual continuation of monthly consolidation on this fantastic company. Now, of course, we're not going to talk about the valuation. You guys already know the valuation is high, but Palantir is a story company, right? I do believe there is a very good chance that Palantir can see tremendous market cap expansion over the next 5 years. Will all of that be done right away within the next 12 months? Probably not, but am I selling any more Palantir shares for the long term? No, I'm keeping them because the business is firing on all cylinders. Moving on to SOFI right now. SOFI also getting rejected at resistance a little bit here, 1.5% to the downside on the day. Resistance range remains 30 down to about 28, right? It's been a challenging area. Resistance was support for a while, and now resistance again. So you can clearly see it is a big price action zone. And the bulls did a great job rallying from the lows, guys. That was a really nice push, right? From the bottom to the top, that was 30%. So if we get a little bit tired right here, the bulls are still indeed in control. Daily downtrend, bullish engulfing move. And now you might just be looking to set some form of a new daily higher low. If they don't have the momentum to crack through this area in one clean shot, they may have to do it in 2 shots overall, but the bulls do remain in full control of this chart right now. The weekly is kind of a bit choppy, right? It was a very nice weekly uptrend right here. Very nice weekly uptrend. The bears got the engulfing move going right there, and now the bulls are trying to recapture this back. We'll see. Maybe they can get it done in one clean shot. if they got to take 2 attempts at it, wouldn't be awkward and would allow us more time for some accumulation, right? This has arguably been a big area of accumulation. I'm still very bullish on SOFI overall. The valuation multiples are pretty fair at 27 bucks. They're about a 1.1 peg and a forward about 7.5 price to sales. So there is still some nice capacity for SOFI to generate those market cap gains that people want to see into 2026 and 2027. The growth of the company has never been in question. They're now a profitable business, growing all their metrics, as we did cover during earnings, very well, right? And in terms of the EPS gains here, nice EPS gains over the next few years and nice revenue gains as well. Can SOFI make its way into the $50-60 billion market cap club over the next 12 to 24 months? Quite possibly, right? But if we do pull back a little bit lower, I will be writing some put options down here, 25 down to 22. We've been having a good time selling some put options down here and just farming some premium. I'm still holding all of my SOFI shares, not selling any. And if we come back down here, just as I did when SOFI did come down there, I will be adding to my SOFI share positions if we do pull down there a little bit more. But as of right now, not looking too bad. Moving on to Uber right now. Uber, phenomenal day by Uber. They had one little piece of news today, which was this. Uber and NBIS's AV Ride just launched all-electric robotaxis in Dallas, covering about 9 square miles from downtown to uptown. Riders who request Uber X Comfort or Comfort Electric can be matched with an AV Ride at no extra cost with an onboard safety specialist, kind of like Tesla was doing for now, and fully driverless service planned later. So nice to see NBIS's venture, AV Ride, with Uber partnership. So Uber tends to rally on these partnership days, and today was no different. Nice daily uptrend being set by Uber right now into resistance, 91 down about 87. We were talking about down here being a great buying opportunity. Hopefully you guys are able to kind of pick up some Uber shares, as in the low 80s. It was pretty good. I did add some Uber shares down there for my long-term portfolio, and we were having a lot of fun playing the wheel down here, right? Just selling put options down here into the 83 down about 77 range. Very high quality company at a deep discount right now. From the top to that low, it didn't seem like much, but that was 20%. Happens pretty fast, right? That being said, the bulls are looking good. If you get a bit of a retracement down, you're looking for a higher low, anything above 85, looking for a bit of a daily higher low to maybe keep this going. And the weeklies as well, right? It's a weekly downtrend, so they got to get that back. In terms of the weekly bounce right now, pretty good, 50%. So it does give the bulls some space, right, to maybe two-step this process if they can't just V-shape it in one clean shot. And if you do make your way down there, I will once again be doing what I love to do on my favorite companies, right, which is just selling some put options, writing put options down here and collecting some very decent premium. So Uber, not looking too bad. And last but not least, good old Taiwan Semi. So TSM up 1.15%. Solid expansion here, going for the daily uptrend, recapture of the EMAs, bouncing cleanly out of support, which is your 280 down to 270. There's never been a problem with this company, right? They had beautiful earnings. We covered them on the channel. Beautiful earnings. And then about a week and a half ago, you remember they raised prices. They said that they have so much pricing power that for the next 4 years, they'll be raising prices 5 to 10% per year, and people will gladly pay. So TSM has had nothing but bullish news, but has suffered a bit of the same momentum declines that some semis have faced recently. It was a weekly downtrend, so we will see, can the bulls get this back? Nice bounce out of support, nice bounce out of the weekly 12 EMA. Not looking too bad for TSM, man. They had their monthly pullback, but it just didn't come deep enough for me to activate any either leap call contracts or things of that nature, right? I'm focusing on other names with deeper discounts and, closer technical touches to long-standing moving averages, but there's nothing wrong with TSM. I'm still holding all my shares. I didn't add any shares. I focused more on other companies with steeper declines, but the business is looking really good into the next 4 years, let's be honest, yeah? Around 295, the valuation is fair, still under a 30 multiple, and a 1.68 peg. So it's not bad. And as I've been saying through this entire period, would I be opposed to nibbling some TSM shares here? No. Would I be going full size? No. That should have been done all the way back here when I kept pounding the table on this company, but overall looking pretty good. TSM, for me at least right now, is a hold, and I'm definitely not selling anything right now, but also no swing trades for me. I'm kind of focusing on my other swing trades. You guys probably would have guessed it, right? NVIDIA, Amazon, AMD, some of the ones that have pulled back a little bit more, but shout out to TSM, man. Still one of the highest quality companies with the strongest moats and one of my favorite companies in my own long-term portfolio. And that concludes today's video. Hopefully you guys enjoyed. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. We do these every Monday to Friday after the close. And last but not least, if you have any questions, please feel free to leave them down below in the comment section. Any questions, feedback, constructive criticism, I'm open to all of it, guys. I always love reading your guys' comments and questions, and I'll answer you as soon as possible. That's it for me. Take care, guys. As I said, if tomorrow's jobs report presents some early morning weakness, there could be some nice opportunities to sell some put options, as we described on the top 5 options list in the Sunday video. So hopefully you guys have been finding some nice opportunities this week so far. We definitely have been in the Discord. So hopefully you guys have been doing that just the same. Take care. That's it for me. I'll see you guys tomorrow. Peace.